The 16th of September, 1992, London, United Kingdom. As the sun rose over the city of London, the British government was already in panic mode. Billions were being spent to defend the pound. Interest rates were spiking by the hour, and nothing was working. By nightfall, one man had made over $1 billion, and the British economy had been brought to its knees. This is how George Soros crashed a nation's currency, and did it on purpose. George Soros was not born into power. He earned it by learning how to see what others missed and betting big when he did. Born in 1930 in Budapest, Hungary, Soros grew up under the shadow of war. He survived both Nazi occupation and Soviet repression, experiences that shaped his view of human systems as fragile, even the ones that pretend to be invincible. His Jewish family lived under false identities, bribed officials, and stayed one step ahead of death. In chaos, he learned control. In lies, he learned leverage. In 1947, he fled to London, carrying little more than his wits and a deep distrust of authority. At the London School of Economics, he studied philosophy under Karl Popper, who introduced him to a radical idea that all human understanding is inherently flawed, and reality is shaped not just by facts, but by perception. This idea reflexivity would become Soros's secret weapon. In a world where people believe markets are rational, Soros believed the opposite. Markets are emotional, cyclical, and manipulable. If enough people believe something will happen, it often does. After graduating, Soros tried to break into finance. It wasn't easy. He worked as a traveling salesman, a clerk, and eventually landed in arbitrage at merchant banks in London and New York. He was smart, but more importantly, he was patient. He spent years developing trading strategies based on large macroeconomic trends, shifts in currencies, interest rates, and national policies. While others watched the news, Soros watched the forces beneath it. In 1970, he launched the Quantum Fund with just $12 million under management. It quickly became one of the most profitable hedge funds in the world. Unlike traditional investors who played it safe with stocks or bonds, Soros bet on entire economies, currencies, central banks, and political systems. He didn't trade with caution, he traded with conviction. And when he acted decisively. When he saw a mismatch between a currency's real-world strength and its artificial peg, he didn't hesitate. He would short it, hard. And when the pressure became too much for that currency to bear, he would profit massively. By the early 1990s, Soros wasn't just rich. He was feared. Because while most traders followed the market, George Soros knew how to move it. In the early 1990s, Europe had a dream, a unified economy. And at the heart of that dream was a system called the European Exchange Rate Mechanism, the ERM. The idea was simple on paper. Tie European currencies together within narrow trading bands to maintain stability before launching a single currency, what would later become the euro. Britain joined in 1990, pegging the pound sterling to the German Deutschmark. But what looked like unity on the surface was, in reality, built on contradictions. Germany's economy was strong, disciplined, export-driven with low inflation. Britain's? The opposite. It was wrestling with high inflation, high unemployment, and sluggish growth. And yet, under the rules of the ERM, Britain had to maintain the pound at an artificially strong level, even if that meant raising interest rates during a recession, just to keep foreign investors confident. To Soros, this was blood in the water. He saw the trap the UK had walked into. They were trying to protect the value of the pound while also trying to avoid economic collapse, and doing both was impossible. Sooner or later, one would give. And when it did, Soros would be there. He began quietly building a short position against the pound. That meant borrowing pounds and selling them on the assumption that he could buy them back later at a lower price, pocketing the difference. The bigger the short, the more pressure it put on the pound. And Soros didn't just bet, he committed. While many hedge funds waited on the sidelines, Soros went all in. He borrowed billions, leveraging his position to apply maximum pressure. By early September 1992, the Quantum Fund had amassed a short position worth over $10 billion. It wasn't a guess. It was a siege. British officials believed they could hold the line. They believed that by using their currency reserves and adjusting interest rates, they could keep the pound within its ERM band. But Soros understood something they didn't. Belief doesn't stop a run. Pressure breaks policy. And pressure was mounting by the hour. The stage was set. The clock was ticking. And on the 16th of September, 1992, the British government would wake up to find itself in a financial war with a single man. The 16th of September, 1992. London woke to a financial system under siege. By 8 a.m., panic was already spreading across Europe's financial markets. George Soros and the Quantum Fund had executed one of the largest short positions in currency history. And now, it was time to collect. The British government, led by Prime Minister John Major and Chancellor Norman Lamont, believed they could hold the line. They had been briefed the night before. Hedge funds were circling, and the pound was under pressure. Still, they insisted that Britain would not and could not exit the European exchange rate mechanism. To do so would be a political humiliation, a financial retreat. Their first weapon? Interest rates. The Bank of England raised them from 10 to 12% in a matter of hours, a drastic move meant to attract investors back to the pound. But Soros wasn't moved. He kept selling, and as the selling intensified, the government tried again, announcing a second emergency rate hike to 15%. It was a desperate signal. We will do anything. But no one believed them anymore. Behind closed doors, the Bank of England was burning through its reserves, buying up billions in pounds to artificially prop up the currency. By mid-afternoon, they had spent more than £27 billion, and the pound still refused to stabilize. The markets had smelled blood, and the sharks were in a frenzy. Within the trading rooms of London, traders watched the spectacle unfold in disbelief. Phones rang non-stop. Screens flashed red. The government's credibility and currency were vanishing by the hour. International investors, who had once trusted the pound, were now betting against it. The British public, unaware of the technical mechanics, began to feel the tremors in interest rates and shaken headlines. In New York, Soros watched it unfold with chilling clarity. This wasn't a gamble. It was the execution of a plan that had been weeks in the making. As other funds cautiously joined in, Soros's head start gave him a dominant edge. He was leading the charge, and the market was following. By 7 p.m., the British government surrendered. The pound was pulled from the ERM. The peg collapsed. Interest rates were rolled back. The illusion of stability was shattered. In one day, George Soros had made over $1 billion. Britain had lost billions trying to stop him. The event would go down in history as Black Wednesday, the day a sovereign nation was broken not by war, not by revolution, but by a single bet. The headlines came fast. The man who broke the Bank of England. Speculator turns into executioner. Soros became a legend in a lightning rod. Some hailed him as a financial genius who exposed a flawed system. Others condemned him as a predator who profited off a nation's misery. But whatever your view, one fact couldn't be denied. George Soros didn't just predict the fall, he caused it. When the sun rose on the 17th of September, 1992, Britain was no longer the same. The pound had collapsed. The country's financial credibility was in shambles. Overnight, the UK had lost more than £3 billion in failed defenses and an unmeasurable amount in prestige. The Bank of England, once seen as a fortress, now looked like a paper wall. Public confidence evaporated. Mortgage holders panicked as interest rates whiplashed from 10 to 15% and back again. Businesses struggled to forecast anything. Investors who had once trusted British financial policy now second-guessed every move. The Conservative government, already strained by economic recession, was humiliated. Their central promise that Britain's place in Europe was secure and the pound was strong had imploded on live television. And at the center of the chaos was a name few had heard before: George Soros. Within 24 hours, British tabloids had dubbed him the man who broke the Bank of England. News anchors called it a financial ambush. Politicians fumed. Chancellor Norman Lamont tried to salvage dignity, insisting the UK had acted responsibly, but no one was buying it. To the public, this wasn't just a market fluctuation, it was a national embarrassment. The pound's devaluation had exposed not just a currency imbalance, it had exposed weakness in Britain's political and economic strategy. Yet even amid the outrage, something unexpected happened. The pound's collapse, while devastating in the short term, ultimately helped the economy recover. Freed from the artificial constraints of the ERM, the UK was able to lower interest rates, boost exports, and eventually emerge from recession faster than many of its European neighbors. In the long run, Black Wednesday made Britain more economically flexible. But that didn't change what Soros had done. He hadn't just won a bet, he had outplayed an entire government. While some saw him as a necessary correction to a system that refused to admit its flaws, others saw him as proof that modern finance had gone too far, that a single man with a fund and a theory could destabilize nations. For Soros, the fallout came not in legal consequences but in reputation. He had become a myth, a warning, a target. The man who cracked the pound, the billionaire who made $1 billion in a day, a villain to some, a prophet to others. A symbol of how markets had outgrown borders. But one thing was certain. He'd changed the rules. From now on, no central bank, no government policy, no national currency could assume it was safe from scrutiny or speculation. After Black Wednesday, George Soros was no longer just a hedge fund manager. He was a force. He had done what few thought possible, exposed the fragility of national policy, defeated a central bank, and walked away with over $1 billion. In the world of finance, that made him a legend. But in the public imagination, it made him something else entirely, a shadowy figure capable of toppling governments with a few trades and a quiet grin. And it wasn't just about what he did, it was how he saw. At the heart of Soros' strategy was a theory he had been refining for decades: reflexivity, the idea that markets are not logical, self-correcting machines but feedback loops, driven by fear, greed, and perception. When people believe something will happen in the market, they begin to act as if it's already true. That action then creates the reality they feared or hoped for. Soros didn't just play the market, he shaped it. This idea challenged the orthodoxy of efficient markets and rational actors. It suggested that reality in finance was bendable, and that those who could see the cracks in consensus could move billions with just a nudge. In Soros's hands, a market wasn't a fact. It was a story. And if you knew how the story would end before anyone else, you could write your own ending and cash the check. But that power came at a cost. As Soros's fame grew, so did the backlash. He became a lightning rod, admired in financial circles, feared by policymakers, and demonized by conspiracy theorists. His Jewish heritage, immigrant status, and global influence made him a perfect target for those seeking a villain behind complex problems. Politicians began name-dropping him to score populist points. Entire movements formed around opposing what they imagined he stood for. None of this was accidental. Soros's real offense wasn't just his wealth, it was his visibility. He wasn't content to sit quietly with his billions. He began funding open societies, supporting democratic reforms, and advocating for transparency and human rights around the world. To his supporters, he was using his fortune for good. To his critics, he was interfering with sovereignty. But whether you loved him or loathed him, one truth remained. Soros had proven that markets were built on stories. And whoever controlled the story, controlled the system. George Soros didn't just break the Bank of England. He broke an illusion that governments, with all their power and policy, could withstand the will of the market if the math didn't add up. After Black Wednesday, everything changed. Currency speculation became more aggressive. Hedge funds grew bolder. The idea that a single investor could take down a central bank went from fantasy to precedent. And Soros became the blueprint not just for success, but for strategy. His move wasn't reckless. It was researched, calculated, and timed with surgical precision. The reflexivity theory he championed, once dismissed by academics, suddenly looked prophetic. Soros had shown the world that perception could move reality. That if enough people believed the pound was overvalued, it would become overvalued. That fear wasn't a flaw in the system, it was a lever. In the years that followed, financial institutions adapted. Central banks became more cautious, governments more guarded. Risk models were updated to account for the Soros effect, the possibility that a single, well-informed actor could destabilize an entire economy. Regulatory agencies began watching hedge funds more closely, but the genie was already out of the bottle. More importantly, Soros's actions inspired a generation of traders who saw markets not as machines, but as stories, narratives to be read, challenged, and rewritten. In that way, his legacy isn't just about wealth, it's about agency. The belief that one person, with enough insight and resolve, can challenge the strongest economic forces in the world. His name remains controversial. For some, he's a genius who exposed structural weaknesses. For others, he's a manipulator who profits from collapse. But love him or hate him, his influence is undeniable. He didn't need tanks, armies, or elections. He just needed data, conviction, and one well-placed bet. Black Wednesday wasn't the end of anything. It was the beginning of a new kind of power, one where borders mean less than capital, and stories move faster than governments can react. And at the center of it was one man, watching, waiting, and calculating.